Hey everybody, my name is Brandon from StocksNews.com, and today I want to talk about the three stocks that I'm watching this week. Those three stocks are NIO Stock, ticker symbol NIO, Alibaba Stock, ticker symbol BABA, and lastly Exxon Mobil Stock, ticker symbol XOM. So now let's get started. So here we are on Google, and here's a look at NIO stock charts here, and we can see not too much bearish commentary on the stock here. Actually, we are getting some positive comments from analysts and journalists at the moment with no real macro bad headlines, and that's a bullish sign to me. Moving on quickly to the stock charts here, we can see that we are in a very interesting pattern. Since our lows here back in mid-May, we have been really riding the elevator upwards, up over 50% from this $30 level here. And it looks like NIO has surpassed this resistance level as well around the $45 level. Because of this, NIO could make a run up to the mid $50 resistance level made from the bottoms of these candles over here and the tops of these candles over here. I think that is where the next spot NIO will be tested in this uptrend here if we keep going. Again, we are right at a resistance level made from this candle over here. So we could get rejected from this level and then fall back down into the lower 40s. I think that there are short-term risks for the stock at the moment because we did have a pretty large sell-off on Friday. So I think if NIO gets caught up in the downdraft of the overall stock market, then we could reach the low 40s again, and that would be the next place where I would be looking to add to my position in NIO if I wanted to add more to my position in NIO. I think because interest rates have come back down some, and because NIO does have a lot of macro tailwinds with the EVs, which we will talk about later, that NIO does have the potential to come back to these all-time highs up here in the mid-50s and even into the 60s. So after talking about NIO stock charts here, let's head on over to the macro story of NIO while looking at the most recent earnings report, which I pulled up here. From this most recent earnings report here, we can see that NIO is doing quite well in terms of growing its car deliveries year over year. We can see that this is undeniably a good year-over-year growth. Even though this number is a little bit funny because when you compare last year's Q1 versus 2019 Q4, we see this drop here, and that's likely due to the health crisis. So I'm mentioning this funny number year over year because when we look at the more detailed earnings review here, which I pulled up in this tab here, the part I want to focus here is the quarter over quarter view of the numbers, which is this column here. I don't really care about the year over year view because, as I said, that last year number was kind of muddied by the health crisis. Another reason why I want to look at the quarter over quarter number is because for a growth story like NIO, I want to make sure that they're not just growing year over year, but I want to see them continue to accelerate growth quarter over quarter as well. And we are seeing that with NIO. We see that vehicle sales here, which is this line on the earnings report, is growing about 20% quarter over quarter, and that's impressive. However, even more impressive is their ability to continue growing the gross margins. We see the gross margins here on this line is growing 36.2%, and that is incredibly impressive, and that's even more impressive to me than the vehicle sales. This is showing that NIO is finding efficiencies in their process and improving those efficiencies. The last number I want to point out is the net loss here. We can see that the net loss here is falling by 67.5%. What that means is that we are slowing the amount of money that is leaving the business by about 70% quarter over quarter. So those are all things that I like to see in the companies that I invest in. And right now, the numbers to me are not too shabby at all. So after talking about what's going on in NIO's business, the last point I want to mention is at the end of the day, this is a growth company, a hyper growth company actually, especially because our market cap of the company here is around $76 billion when we don't make anything. We are actually operating at a net loss. I think that because interest rates on the United States 10-year treasury bonds are still low and will likely remain low until the end of 2022 or 2023, that high growth names like NIO or other tech companies can continue to do quite well. However, there are risks here as always. NIO is a Chinese company, so there are geopolitical risks that investors need to weigh in their decision. Also, there is competition. There are a lot of EV companies in the pipeline right now at the moment, and a lot of them are in China. They are looking at NIO and will be trying to eat their lunch. The risk that investors take when investing in NIO is that they have to think that NIO will be able to continue innovating and continue growing at the pace that they are growing at in order for them to stay ahead of the competition and stay within the top 3 companies of China's EV market. So after talking about what's going on with NIO, Now let's talk about Alibaba stock, the Chinese e-commerce company. So here we are in Alibaba stock, the Chinese e-commerce company. We can see here in the stock charts that Alibaba is in a pretty interesting spot technically here. Technical chart analysis people will say that BABA looks to be in a descending wedge pattern. Basically, if you make a line here connecting the all-time highs from the relative highs down here, it looks like a straight line downwards. Also, if you try and make a straight line from these lows here, you can see that the bottoms of these candles here really make a horizontal line here. So if you look, this descending line here looks to be intersecting with this horizontal line over here. To technical analysts, that means that there's tension building up here between the buyers that are coming in at the support level here, as well as the sellers that are coming in off the downtrend from here. And when we get to an apex of that wedge, that normally resolves itself pretty dramatically. We can see that the last time Alibaba saw itself at this formation, we broke down dramatically lower here, where if we make the horizontal line from these lower candles over here and the same uptrend here, we can see that there was an intersection point here and Alibaba resolved down sharply. But now the question is, what will happen at this intersection point? And obviously nobody knows for sure. But again, that's why I'm watching the stock this week. If BABA resolves downwards like it did last time here, then I will be looking to add some shares to my position. And the reason for that is because I like the macro story of Alibaba. I like the growth rate and the valuation of Alibaba. So to see that now, let's head on over to Alibaba's earnings report and we can see the growth rate that I'm talking about. We can see that total e-commerce is up about 72% year over year. And the side businesses are also growing up over 64% year over year. So just one thing I want to point out here, look at Alibaba's scale. Even in its side business, not the main business of Alibaba, is a cloud computing business, and that is growing a nice 37% year over year. And the magnitude of that business is $2 billion. We see here it's listed as $2,000 million, which is $2 billion. I think this sector of Alibaba's side business will grow substantially over the next few years as we all head on over to the age of data analytics and the science of big data. And it's mind-blowing to me that already Alibaba has a multi-billion-dollar business as a side business. With that said, I also again want to draw attention to the PE of Alibaba here. We are currently at around a 25 price to earnings ratio. Comparing this to Amazon, Amazon has a 66 PE ratio. What this is telling me is that Alibaba is trading at an extreme discount to Amazon, and depending on your point of view, it may be for good reason. Alibaba does have a lot of risks associated with it. It is a Chinese company, again, so immediately, of course, there are geopolitical risks that are involved here. Not only that, but Alibaba is still under regulatory scrutiny within its own country. It just paid an anti-monopoly penalty fee, and the pressure will likely not let up for a while. But again, to me, the growth rate that Alibaba has and the likely tailwinds of e-commerce as a sector growing over the next few years will likely continue to benefit Alibaba, in my opinion, despite these downside risks. Those are just a few reasons why I'm overweight Alibaba in my portfolio at the moment, but as I've said again, it's a bit risky on the regulatory side. So with all that said, now let's take a look about the last stock that I'm watching this week, and that stock is Exxon Mobil. The last company I want to talk about today is Exxon Mobil, the oil company. Now, before we get started, I think it's a good idea to just quickly mention that to me, morals do play a role in investing. What I mean by that is that everybody has a sense of what is right in the world and what is wrong in the world. And your definition of what's right and what's wrong may be different than what my definition of what's right and what's wrong. And that's perfectly fine. As investors, we have the opportunity to obviously make money, but fundamentally, we have the opportunity to be able to lend our money to certain companies or government entities to make changes in the world around us. By investing in a company that makes electric vehicles, we are basically lending the company the money that they need right now in order to give the company the best shot at making electric vehicles for the future. However, the idea of investing in an oil company like Exxon provides some cognitive dissonance here for people who imagine a green and environmentally friendly future. This is when investors need to make a decision. Investors need to decide how much they should weigh their morals in their investing decisions. And of course, there is no right answer. You can invest in things that align directly with your morals, or you may throw your morals out the window and invest in anything that you can make your money on. And by Exxon showing a nice, juicy 5.56% dividend yield is definitely a stock that you could make money on. Again, the reason why I'm mentioning this is because what you do not want happening is making an investment decision right now to do something or to not do something and regret it in a future point in time if the stock goes up or down. At least if you think about morality in investing right now, you may save yourself from some cognitive dissonance in the future. So with all that said, when it comes to Exxon and the oil companies in general, I am a bit bullish on the sector. The reason for this is mostly because of underinvestment in the space. To understand oil and oil stocks, really the easiest and fastest way to do that is to understand the supply and demand dynamics here. Because we are turning to the summer season here in the United States, summer means travel, and likely a surge in travel because of the health crisis from last year. In order to travel, we need oil, so the demand for oil from you and me increases, which increases the price of oil, which likely leads to increase in oil stock prices. Also, because the past few years, oil companies have stopped investing in drilling due to environmental concerns, and to me, they should have done that years ago to protect our planet. What that means is that companies are pulling less oil out of the ground, which lowers the supply of oil in circulation. That, again, is bullish for oil prices and will likely be bullish for oil stocks as well. This will not really show up in the earnings report here because the earnings report is backwards looking, but over time, this supply and demand dynamic should be bullish for the fundamentals of companies like Exxon Mobil. Really, on the earnings report here, the only thing I want to point out is that they do have pretty decent revenue growth, which is this on an earnings report here, year over year. So with all that said, transitioning over to the stock charts here, we can see that ever since our double bottom here back in October of last year, Exxon Mobil has really been on a staircase ride upwards. It has been absolutely ripping since our lows in October, up over 100% since then. I think even with our sharp declines here the past couple trading days, if we zoom in here, I still think that Exxon still has some upside left, and this uptrend looks incredibly strong. I think around the $60 level or $62 level around here would be the place where I would add to my position if I had a position in Exxon.